Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast connecting you to the world of investing and helping you stay ahead. How's the state of the Canadian consumer? Is the Bank of Canada on the right pace in terms of rate cuts? And what does Canada's recent unemployment rate mean for the broader economy? Joining us to discuss this and more are research analysts Thomas Goldthorpe and Brendan Cochrane. Brendan discusses the recent 25 basis point cut by the BOC, saying the consumer would probably have benefited more from a bigger cut. He says with the refinancing of mortgages, this recent cut still affects the consumer's discretionary spending. But Brendan adds they are still bearish on the Canadian consumer, and there are still great opportunities in the consumer discretionary sector. Thomas says there may be more cuts on the way, but it will take some time for the cuts to be fully made. Inflation is at 2.5%, down from where we were before, but he says it feels like we're trending towards an inflation regime that could look something like pre-COVID days. They also touch on luxury consumer goods, the ongoing discussion on a soft versus hard landing, and the Canadian banking sector. This podcast was recorded on September 6, 2024.
Brendan, I'll begin with you, if you don't mind. We saw the rate cut, third in a row out of the Bank of Canada. It was 25 basis points. Would you have wanted it to be more? You're looking at the consumer.
Yeah, I would say, speaking on behalf of the Canadian consumer, I would say we definitely wanted it to be a 50 basis point cut from a consumer's perspective. Things are really tough in the Canadian consumer landscape right now. We're seeing a lot of slowdown across all income bands. I'm sure we'll get into some of those details later. But safe to say, I think the Canadian consumer out there who's looking ahead at a potential mortgage refi over the next 12 to 18 months, I think they probably wanted 50 basis points.
Okay, well, let's talk about the mortgage refis for just a second here. We'll dig into what the bank's move ultimately means for the mortgage market. It looks like we're going to get a lot of cuts. I mean, that's what the market says. We're going to get an awful lot more cuts. What do you think? Good enough for the mortgage story?
Yeah, so I think, so there's two parts there. So one, on the rate cuts, you always have to remember that it's the overnight rate getting cut, not necessarily the 5-year rate. So there's a chance that as we see more rate cuts, not all of that will translate into a lower 5-year rate. And if the 5-year rate doesn't come down, that generally doesn't lower the underlying mortgage rate.
That's how the mortgages are priced.
And then the other part of it is even with rates today at roughly 2.8% on the 5-year versus rates of over 4% at the peak, 2.48 is still much higher than the sub 1% 5-year in 2021. So even at today's lowered interest rates, that's still a material rate increase on these mortgages that are reset. So to put it into context, a mortgage being reset at today's rate in 25 and 26 is roughly worth like 15% of consumers' discretionary spending. So what we've seen is rates that have already been reset they've lowered their spending around that amount, and we should still expect that level of spending cuts in 25 and 26 for these customers that are resetting their mortgages.
Okay. And there are a lot of them. We know in 25, 26, we're talking about sort of this bolus of people that will be going through this. Brendan, tell us a little bit about what maybe you'd like to look through. And I guess we'll ask if you can look through this sort of bolus of mortgages have to reset and therefore crunching the consumer's budget.
Yeah, sure. So as Thomas mentioned, 10 to 20% of consumer discretionary spending is at risk for people who are refining their mortgages. That's about $500 per household per month. So what we're seeing here when I'm looking at consumer discretionary stocks, this concept of discretionary versus staples. If you simply don't have that money, that $500 is consumed by a mortgage and you need to live in your house, where are you going to take it from? So the more discretionary the spend is, the more at risk it is. So in my coverage, for example, I have a whole range of companies from basically staples like companies like Dollarama, where those are everyday products you're going to need to buy no matter what. I have telco companies where you're not going to cut your internet, you're not going to cut your cell phone. But then I cover companies like BRP, they sell jet skis and ATVs. If money's tight for you, you're probably not going to be buying an ATV for your cottage, it even seems silly to say that now, but yeah, you're not going to be buying any new ATVs when money's tight for you. So
those were the types of sort of consumer stories that were the COVID darlings.
Exactly.
But we're in a very different world right now. Talking a little bit about where mortgages are going to settle in, which is still higher than pre-COVID. Thomas, haven't we had a couple of years to get used to the fact that we're probably not going back to pre-COVID interest rates for mortgages? I mean, is that settled into the pricing of the banks, the pricing of and kind of the sentiment that we live in right now? Or were we expecting them to go down to pre-COVID levels?
No, I guess we likely will not go back fully to pre-COVID levels because inflation will be a bit higher, but we could get reasonably close to pre-COVID levels.
So you think there'll be a lot of cuts?
Yeah, I think we will see a lot of cuts, but I think it's going to take time for those cuts to fully be made. Because ultimately, if you look at inflation today, inflation's at 2.5%. It's down materially from where we were before. It's still above the long-term target, but it feels like we're trending towards an inflation regime that will look something like pre-COVID. But I think the bigger issue today is that we will not get back to pandemic level of interest rates. And because the consumer levered up so much during the pandemic, it will create headwinds from when those rates get reset. And also it may force the consumer to delever as they have to readjust their overall debt load for more normalized interest rates and not for the record low interest rates that we saw during the pandemic.
Yeah, it's interesting to sort of take a look at how bearish a story this is. But there is a way to invest around this, which we'll go to. Take us through the Canadian consumer discretionary, the sector itself, ultimately how many are totally domestic facing and therefore exposed to exactly what we're talking about.
Yeah, so the answer is surprisingly little. We just did a big report, a research report, nice 60-page deck. I can't share it with our audience, unfortunately, but we do have all of those details in there. So the key is that amongst the TSX consumer discretionary space, there's really only 4 companies that are pure play 100% exposed to the Canadian
Really?
consumer.
Only 4?
Only 4.
Okay.
Yeah. The other ones are effectively U.S. companies selling products to a healthy U.S. consumer, that some of them have growth, some of them have margin stories. So when we talk about the Canadian consumer, and you might think, okay, why do I have exposure to the TSX, the consumer discretionary sector? There are some real gems in here that are effectively U.S. companies that happen to have headquarters in Toronto and therefore happen to be on the TSX because that's one of the requirements. Otherwise, these are basically U.S. companies. So you have to really deeply understand who these companies sell to, what are their country positioning in, what is their income level positioning, because there's all low-end positioning, there's high-end positioning, who are the trade-down winners, and then you can make that stock picking selection, which goes into all of our funds. So yes, I know we're clearly a little bit bearish on the Canadian consumer, but there's some really great opportunities in Canadian consumer discretionary.
So I want to talk about trade down and the different levels in just a second, but I guess also selling into a U.S. consumer, there's also currency. There's all kinds of things there.
Yep, and currency is very interesting because we are an export economy. When you think about how important the auto sector is, we have some large auto suppliers on the TSX as well. They are making products with Canadian labor and Canadian dollars and selling these parts to U.S. companies across the border to Detroit in U.S. dollars. So in that situation, if we get more rapid rate cuts, that will pressure the loonie, which is actually positive for export companies, and the consumer discretionary sector in the TSX has a lot of export exposure.
And so you can sort of stock pick around those. Thomas, just take us slightly to a different direction. Back to banks generally, the overall story. Is there some clarity? This goes to can we look through? Is there some clarity on the PCL story at this point? I felt like we lived in a bit of a haze when rates were still rising. We're now on the downward trajectory. Is there some clarity there? Do we need that clarity? What does it mean?
Yeah, I think to take a step back, credit has been deteriorating for effectively the last 2 years. So effectively every quarter, basically every day, PCLs are ticking up, impaired loans are ticking up. things continue to get worse on the ground, both in credit but also in the economy, as we saw with unemployment. So for now, that trend looks to continue, and it's still unclear exactly where that's going to peak out. Because as we know,
it is still unclear.
It's still unclear. I think it's too early to kind of wave the flag and say we've seen the peak. And the big thing to remember is interest rates impact the economy with a lag. So we've seen it with the mortgage rate resets, and I think we will see it with in construction, specifically with condos, as there's a lag between when condos are sold and when they're constructed, and it looks like, at least for the next year or two, we're going to see kind of weaker construction as well. So I think it's still a little early to be drawing those conclusions, but ultimately these rate cuts will flow through to better performance, but just with a lag.
Yeah. Okay. So really interesting to just sort of get which parts of it we have clarity on. Something that we have had clarity on for some time is the different levels of the consumer, where they want to buy and where they're switching to buy. I feel like this isn't a new story. Is it still the story though? It is
still the story. I would say the trade down dynamic has escalated to the point of trade out. So let me expand on that. So if I bracket the consumers into, let's say 3 buckets: low income consumer, medium income, and then high income. In the low income space, you have that idea of, going from a Starbucks coffee a day to a Tim Hortons coffee a day, right? The trade out, that's trade down. Trade out is when you just make a Folgers coffee out of a tin at home and you put it in the thermos and you bring it to work instead.
Kind of tastes the same.
Yeah, versus a Tim Hortons coffee. Actually, I cover Tim Hortons. Maybe I shouldn't give my opinions on Tim Hortons coffee. But so I think we're there for the low income consumer. We're at the trade out situation. The middle income consumer, there are several public companies, Canadian Tire, Pet Value, that they make statements on their conference calls. Everyone is in agreement that it's tough out there for the middle income consumer. And more importantly, in the areas of Canada where there is more indebtedness, more mortgages, so Toronto, Vancouver, Montreal, those are seeing the most rapid slowdown.
Because of the most expensive housing, and people have had to go into debt so much more.
Exactly. And then finally, on the high income consumer, I think I messaged before when we were last here that we had been seeing cracks, and the cracks are getting deeper, and now it's pretty clear that you can see it all throughout high income.
Which is kind of luxury. We think of it as luxury.
Call it luxury. So an anecdote I can provide. So something really interesting is mattress sales. So we track mattress sales.
Are mattresses luxury?
So there are luxury mattresses.
There are. Okay.
So what we've seen more recently is the $3,000 plus mattress category has slowed dramatically. So think about what kind of person would spend $3,000 on a mattress. That gives you a sense of that income level that is starting to slow, what kind of houses they might own. Those people are starting to slow. Now, a little interesting tidbit though, there's a $10,000 mattress category.
These are not the ones that come out of the box that pop out.
Those
you
are
have to
not
let them sit for a couple days.
And that category is still doing excellent.
Right.
So the multimillionaires still doing great, still buying $10,000 mattresses. But now the high income household that would have bought a $3,000 mattress, they are definitely trading down. And when you can see it in something like a mattress purchase, which is an 8 to 10 year purchase, when you're making those decisions, it's a pretty good sign things are slowing for the high income consumer.
That's fascinating. Take us through ultimately, how you see some of that, things starting to hurt. And this, the banks, the financials will worry about the economy where things are starting to hurt. It's not good for them. Take us through the aspects of the banks reporting earnings, their businesses of where this will be felt.
Yeah, so what you see is obviously more losses, more delinquencies, which lead to more write-offs, which lead to more credit losses. So the one thing to say on that, though, is within Canada, our mortgage system is also very different than the US. It's fully recourse. So what we've seen is Canadian consumers have been able to change their behaviors to continue to pay their debt at the expense of kind of discretionary spending. So instead of buying that mattress, you're paying your mortgage instead. So the optimistic view is that credit has actually done a bit better than people would have expected if I told you before, a year ago, where interest rates would be and where unemployment would be. Credit actually has done a little bit better than expected, but at the same time, credit has got worse. And really, I guess the tension in the market right now is you really are kind of trying to balance three scenarios here. So you have one scenario where we do get the soft landing.
This is in Canada.
In Canada.
Yeah, okay.
And traditionally after soft landings, you do get acceleration in debt growth. You have another scenario where you get a soft landing, but maybe you don't get that acceleration in debt growth because the consumer has come in with record leverage and maybe there's not more room to re-lever their balance sheet. And if rates are a little bit higher, maybe they can't afford it even at lower rates. So that's more, and generally when the economies, when you go through deleveraging, that causes stagnation. So and then the third one is, more draconian, just full credit cycle, right? So right now, so those are the three things. And then, in terms of bank earnings, if you think we get a true reacceleration in lending, that's clearly good because growth in debt generally correlates with growth in earnings at banks, and that's good. If you get more stagnation, that is not good for the banks. And we kind of saw that globally in the kind of the post global financial crisis period where bank earnings were more stagnant, and then obviously a crash, it wouldn't be favorable for bank earnings either.
When you said parts of the credit story actually are not as bad as expected, are wages partly responsible for that?
Yeah. There's a lot to be said that we do talk about these rate resets, but you always have to take in the context that so right now we're resetting mortgages that were written in 2019, and then actually the reset gets worse in next year and the year after because you're resetting lower rates in 2020 and 2021. So the good positive offset from 2019 is that the average wage of a Canadian employee is up 25%. So that does give them some additional buffer to support the mortgage. And the one offset there is in isolation, that's true, but in today's world, that will come at the expense of lower discretionary spending because employees or workers have adjusted their spending habits to that higher income, and now they have to adjust that income for a higher mortgage payment, or the spending for a higher mortgage payment.
So I might ask, with higher end consumers, the story of them seeing less of the spend going in that direction, there's a trade down. What do they do in moments like this? Like you can imagine there's a shrinking, they have to adjust. Do they start to offer different types of products? Like where's the innovation when people say we're not going to spend as much? And it might be across all boards.
Yeah. So good companies do take a forward outlook on what their consumer is going to do, and they adjust with obviously there's a lead time required, especially if you're making products in China and you need to have different designs come by. So I guess the way to frame it is the good way to do it is you design the products for a lower price point and you maintain your margins. The bad way to do it is you have too much inventory, the environment changes, and then you have to discount all of your inventory. And that's just you're just slicing off EBIT dollars, You're hurting your brand. So there are some companies, for example, in the toy space. Toys is a situation where we did see a lot of trade down where people were buying, during COVID, you bought whatever, the kid was stuck at home and having a tough time. So you bought a $150 Barbie dream house. As times get tough, you don't make those big purchases, or maybe they're only for birthdays. But then eventually, at some point, the manufacturer themselves has to change the toy portfolio. So we do know, and there are some companies that we speak to who have proactively reset their portfolio to focus on slightly, smaller toys, or maybe not so much metal in the toy, more plastic in the toy, so that, it's still the same characters, it's still the same IP that the kids
cheaper
love,
components.
But it's a little bit cheaper. The kid, the child really doesn't notice. There's ways to get around it, but it defends the margin. So it's very important that companies have that proactive outlook on their consumer. And when we saw a lot of this in the supply chain issues of 2022, where there was no supply, no inventory, and then everyone rebuilt far too much in 2023.
and then had to start slashing prices. So it seems like inventory is in a healthy place overall right now. It seems like most companies have redesigned their lines to be lower pricing. So it was a painful 2023 to do so, but for the most part, it seems like these consumer companies all have the message. They all understand the consumer's in a tough spot. They need a little bit more savings. Even if it's material quality, whatever, companies have to find a way to deliver that.
It's fascinating. So we're talking about, in a way, getting through kind of a bumpy time. Take us through sort of the story for banks. Basically, the dispersion, which is kind of unusual. Actually, the banks usually just make sure they pretty much hold together as a group. I mean, it is unusual. What do you think of that? I mean, you watch this all day, every day. It seems pretty interesting.
Yeah, no, it's super interesting. We've had a record degree of dispersion between the top 3 banks and the big 6 and the bottom 3 banks, basically in history, year to date. And the interesting thing of that is, the bank performance has been quite different. There's been a lot of idiosyncratic issues impacting individual issuers. There's been a lot of just performance expectations, wider gaps, and more just differentiation. So the
not
great thing,
necessarily a mortgage story in every case.
right? Exactly, right.
Which is sort of interesting.
And not just credit. There's a lot of different factors, but the great thing for us is we like dispersion because it increases the value of stock picking. So getting in the weeds, really understanding the risks, really understanding the individual nuts and bolts of the company is really paying off for us this year. And it's very differentiated than having 100% correlation, everything moves together. That's only one way you can make money, which is you make the sector call. Whereas when there's a lot of dispersion, you can make a sector call and you can make individual stock calls. And you're really getting paid handsomely to make the correct stock calls in this environment. And that can be done by doing the bottoms up, in the weeds, like talk to management, really understand what's going on.
What you do every day, basically.
Right.
What you do every day. It's interesting because this is also kind of the conversation of, okay, getting through, but it's also, is there a trough story here? I mean, I don't know to what extent there is for the consumer, the financials more broadly, but are you getting to that point or not yet?
Yeah,
Valuations.
Yeah, so what I've seen in the consumer discretionary space is, valuations have largely been holding in. EPS continues to disappoint. So, even though the valuation holds in, if you're cutting your forward earnings outlook, then the stocks, tend to go down. When we're trying to think about timing stocks, you really want to see an inflection point, maybe 6 months ahead. And that's to ensure you're not too early, but you're going to be there before the actual inflection point happens. So what I can say is certain stocks have reached what I consider to be tactical levels, where we might want to go in, even though it might not be a long-term buy and hold. There's an opportunity here on a short-term basis. For the most part, when I look out 6 months ahead, have those earnings inflected? It's tough because we still haven't seen the bottom of the consumer. We still don't exactly know how hard or fast the banks are going to cut. We kicked off this interview by saying, we probably wanted a 50 basis point cut and only got 25. The market is absolutely pricing in there will be 50 basis point cuts very soon. If that disappoints, then okay, maybe there's going to be, it'll delay the pain a bit longer than expected. So there are certain stocks that are attractive today, absolutely. And I have some great ideas I've been buying, but for the most part, we need a bit more time, I think, for the overall.
Okay, and I'll speak to you on the trough, and then I'm going to go to telcos right after that. But let's just talk about is there anything, do we want to talk about troughs and financials at this stage? Is there a V-shape, something?
Yeah, so the question that is always a topic of discussion, like where do you put the pin in, when do you want to buy? And the interesting debate with V-shape is, I kind of alluded to this before, is to get the true V recovery, a lot of times you need the crash first to get the recovery first. Yeah. But if you don't get the crash, you don't get the recovery, you just get flat, right? And that is, so the traditional playbook, right, is things get really bad, you buy when things are the worst, and you get this nice recovery coming out of this. But it'd be interesting if we do get that soft landing, we maybe never do get that crash, and we maybe don't get that cleanse of the system. And it's a curious discussion on kind of what these stocks look like in that environment.
Okay, that's fascinating. I'll ask you quickly, Thomas, you don't mind, because we'll go on to others. So, great question. What proportion of bank earnings come from mortgages versus other loans versus fees? Just go into the earnings as like quick buckets.
Okay, quick buckets. So, yeah, if you're thinking about a bank, it's roughly 50-50 between just pure lending. So I lend for more than I borrow at, you make a spread. It's roughly 50% that, 50% fees. The fees are everything from banking fees to wealth management to capital markets.
Perfect.
And then of the fees themselves, I would have to get back to you on kind of what exact proportion of that spread is linked to mortgages, because they all have different spreads. It's not entirely transparent exactly what that number is.
Yeah. And I'm sure you get the looking glass out to look. It's hard sometimes. Quick question on dollar stores, which you mentioned, and also the auto sector, which you also mentioned. So we'll go into those. But just as we sit at 4.25, I mean, we are cutting in Canada, but we're still up above 4%. Are there yield plays out there that are interesting?
Yeah, there are. Yeah, and I mean, so I cover telecom, so I'll take the opportunity to talk about telecom. So this is a sector that has been pretty much left for dead. It had a really tough past 12 months. That creates an opportunity where when you think about dividend yield, when you're the entry point that you buy a stock at, that's the entry point that you have paid forever. And then so your dividend yield, you have the ability to lock in some pretty attractive dividend yields. Now you have to be careful, because if you're buying, Bell, for example, is at 8% dividend yield. This is well known. If you're buying a stock at an 8% dividend yield, but the stock price underperforms 20%, you're not going to be very happy. So for telcos, we're at a situation where the dividend yields are very attractive. How do you look at the overall sector? There's three quick ways to do so. The first is competitive intensity. How are the players? Are they playing nice together in the sandbox or not? Seems like maybe that's getting a bit better. The second is regulatory burden. Can the government implement some kind of crazy new restriction? For example, taking away data overage fees that were very profitable back in 2019. Can anything happen there? Well, the NDP Liberal supply and confidence agreement just blew up. Trudeau probably doesn't have enough time to do any major regulatory change, so that looks a bit better. And then finally, interest rates. It's a very capital-intensive sector. Interest rates are extremely important. I think if advisors out there get one thing from our conversation today, it's probably that interest rates are going lower. Yeah. That's a good thing for the telcos. So it's a very interesting situation where the sector was left for dead. Those three stars are looking a bit better. I'm not sure if I'd say they're aligning yet, but looking better. So it's definitely a place to be doing work if you hadn't looked at the space in the past year or so.
Fantastic. And the idea of kind of looking through, but we're not there yet. What do you want to leave investors with from the financials broadly? Like, what do they do with financials right now?
I think right now, the way I think about it is, I want to own, what's attractive, because I cover two parts, right? I cover the banks and I cover non-bank financials. So within non-bank financials, you can find a lot of really high quality compounders that can compound in any environment. So I don't have to make a call on credit. I don't have to make a call on rates. I can just make a call that this is a good business that's going to compound well, irrespective of the environment. And within that environment, whether it's Canada, whether it's the US, I think there's a lot of very attractive investment opportunities. And then within the banks, just be careful, mindful of any risks you're taking. And there is a lot of room for alpha generation there, but increasingly, given the high dispersion, I think stock picking is more important than usual than just making a straight sector call.
And there are actually opportunities. Yeah. Thomas Goldthorpe, Brendan Cochrane, thank you so much for joining us here on Fidelity Connects. I feel like all of us learned a ton.
Thank you.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. While visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada, ULC, or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.